Cord. Okay, so on behalf of the Mass Mortgage Bankers Association, I would like to thank both Mass Housing and Mass Housing Partnership for joining us. This is a very important part of our Affordable Lending Summit. I can't think of two more important people and subject matters to discuss as part of the whole process. So I am going to take a moment and let Goretti and Elliot introduce themselves. And I will also remind people that we will be taking questions. We might answer them at the end, or we might, depending upon your question, we might answer them during the presentations. We'll kind of see what you have for questions, but definitely the chat is what we are going to be using. So at that point, ready. Want to introduce yourself and thank you for being here.
Thank you, Debbie, for having us. And I'm Goretti Jokum. I'm the Senior Relationship Manager at Mass Housing. Myself and Angelo help manage the relationship management team. That's the boots on the ground folks. I've been with Mass Housing for 19 years, and it's a pleasure being here this morning.
Thank you for being here. And then Elliot, I know you're presenting after Mass Housing, but can you just tell us a little bit about yourself now?
Sure thing. Thanks, Debbie. Yeah, I appreciate the invite. Happy to be here. My name is Elliot Schmiedel. I'm the Director of Homeownership at MHP, the Mass Housing Partnership, where I've been for the better part of the last 15 years. In that capacity, I oversee our homeownership programming, which largely revolves around one mortgage. But again, it's a series of programs that support first-time home buyers, helping them to buy homes, maintain homes, sustain homes over the long run. So happy to be here to talk about our programs with all of you.
And thank you for being here. So now we are going to start out with we did a kind of coin costs. So we are going to start out with Mass Housing. And if you want to take it away, we are happy to listen to everything that Mass Housing has to offer.
Thank you again. Yeah, it's a pleasure to be here this morning and just talk a little bit about Mass Housing, what we do, who we are, and what 2023 looked for us, as well as what we're doing in 2024. So we're very excited to be able to first and foremost, I must read a quick disclaimer and just basically letting you know that Mass Housing makes no warranty or representation to the accuracy or adequacy, valid, and that you should consult your own professional advisor for business or legal or other advice. And basically what I'm presenting, all of this information can be found on our website, both consumer and partner website. So that would be emasshousing.com. Just to highlight 2023, it was a banner year for Mass Housing, and we were able to close over $697 million with over 2,100 first mortgages. A lot of those were Mass Dreams, 1,140, and those were actually layered with our own down payment assistance. 63% of the lending that we did in 2023 were to borrowers earning less than 100%, and just about 49%, a little over 49%, were to borrowers or BIPOC borrowers. We service the bulk of our loans, and so we have a servicing portfolio of $3.75 billion, and we did some assistance as well on the servicing side. And we mention that because not only is Mass Housing geared primarily for first-time home buyers, or also we do have programs that are for limited cash-out refinance transactions. One of our biggest goals, and you'll see it throughout the presentation, is to reach 50% of our overall lending to BIPOC community. And we're just about that right now in 2024. We're actually just at 50%. And that was a 5-year goal for us. And we're really proud of the fact that we were able to get there in just less than 3 years. Still more work to do on that, but we're really proud about those numbers and what 2023 looked for us. And when we talk about numbers, they're really people. These are borrowers that we impacted. And Alicia is one of those borrowers that was able to purchase using MassHousing's down payment assistance. She worked with Eastern Bank and was able to obtain down payment assistance and purchase her first home. And when we talk about affordability, you know, we often talk about gateway communities and those cities, 29 cities that, you know, we're hoping to assist, but we really lend throughout the Commonwealth. And although Boston, sometimes people feel like, oh, there's just not affordability in Boston, we were able to help quite many people. And Boston's actually on our top 10 list of cities that we assist with our program. So we're proud of that. And also in Haverhill, Gabriella and Abelano, we were able to assist them with the help of Salem 5, with also Mass Dreams and down payment assistance. We no longer have Mass Dreams in 2024, although we're hopeful and you know, hoping that that happens towards the end of the year. But for right now, we have down payment assistance, and a great bulk of the borrowers that we assisted in 2023, we were able to layer not only MassHousing and maybe Mass Dreams, but also other down payment assistance or community seconds that are available through the city of Boston, through the city of Worcester, Springfield, New Bedford, Brockton. So all of those communities have funds and down payment assistance that we often find when you layer those on top of a MassHousing DPA, you're helping those first-time home buyers. So before I go into our new products that we just launched on March 18th, so we couldn't have had better timing for this event this morning. But just to talk a little bit about what MassHousing offers and who we are and what our borrowers must have or in order to qualify eligibility standpoint. So they must own or occupy the property. They must be purchasing in the Commonwealth of Massachusetts. They cannot own any other real property. And then they must meet our income guidelines or our underwriting overlays. The bulk of our lenders, and we have over 80 lenders that partner with MassHousing currently, they're fully delegated. So they're no longer submitting any documentation to MassHousing for approvals. This is something that we made a change on January 29th. And so lenders are fully delegated and they're doing the compliance check on the income eligibility, as well as the other compliance checks required for MassHousing. So all of this information can be found on eMassHousing.com. And we also have a consumer website that's dedicated for borrowers, that is MassHousing.com. And that website for consumers is obviously in English, but also in Portuguese, Spanish, and Chinese. So as I mentioned, it is a huge part and a huge goal for MassHousing to reach 50% of our total overall lending to BIPOC community. And as I said, that is something that we're just at 49%, a little over 49%. We're hoping to be at 50 before the end of the year. And we continue to strive to look at programs and products that are geared for first-time home buyers in the Commonwealth of Massachusetts, but especially to those BIPOC borrowers. And one of the first things that we've had a lot of popular product for us is our Workforce Advantage 4.0. And this particular DPA has been streamlined. So we are offering $30,000 across the state for first-time home buyers who meet the total household income and acquisition cost limits with the first mortgage product. So our DPAs must be originated with our first mortgage programs, and it is available for 1 to 4 unit properties, condos and PUDs at a $30,000 DPA amount, which is amortized over 30 years and a 0% deferred. So there's no monthly payment due, but it is due upon payoff or pay down. So if that first lien refinances, pays down to 0, then the balance of the DPA would be due. And this is eligible on our Workforce Advantage conventional programs as well as our FHA programs. The other down payment assistance that equally popular is our first-time homebuyer down payment assistance, or our 15-year amortized DPA. And the product code for that is 4004. It is for eligible first-time homebuyers purchasing a 1 unit, as well as 2 to 4 units. It is $25,000 statewide, and it has a 2% interest rate and is amortized over 180 months. So that would be around $160.88 payment on a monthly basis. But this allows the $25,000 or the $30,000 for Workforce Advantage can be used for down payment assistance, but also for closing costs and for reducing the interest rate. So as long as there is a reduction in the interest rate, a 2% or 2% origination fee could be used for reducing the interest rate. So that is something new that we've rolled out on March 18th, and that will hopefully help first-time home buyers have a more affordable interest rate. So things that we continue to work on as we look at what we did in 2023, we're looking to streamline and improve for 2024. So next, I'm going to go into our conventional loan products, and we offer a variety of different products. None of these programs have asset tests. They all have a minimum FICO score of 640 and a debt-to-income ratio of 45, and that's true for both our conventional and our FHA loan products. But I'll start with our Workforce Advantage. It has a discounted interest rate, and it comes along with our Workforce Advantage DPA, and it will be for a full $30,000. We do pay for the MI on this product, so the borrower does not have any mortgage insurance cost whatsoever on the Workforce Advantage product. We pay that in its entirety, and with a reduced interest rate. There are acquisition cost limits that apply, and it is eligible, as I said, for single-family condos, PUDs, and 2 to 4 family properties. On a single family, the minimum loan to value is 97%. So that allows the DPA to be used above and beyond the down payment assistance for closing costs and other fees, including reducing the interest rate. And then on our multifamilies, the minimum loan to value is 95, and the borrower does have to have 3% of their own funds into the transaction. That could be for the actual loan, or it could be towards the closing costs. It could be for the down payment of the closing costs, but the borrower must have 3% of their own funds into the transaction for the Workforce Advantage multifamily, 2 to 4 family conventional product. That is not the case for our FHA Workforce Advantage, but it is the case for the Workforce Advantage conventional. Again, lender paid single MI is paid by MassHousing. There is no cost to the consumer, and they do receive our MI Plus benefits. And I'll talk a little bit about our MI Plus benefits, but just real quickly is if we cover the principal and interest payment for borrowers if they become unexpectedly unemployed. So this is great. We also offer a $2,500 closing cost credit for eligible service members and veterans, and we are looking at the total household income. The other thing that I would want to point out is that the combined loan to value goes to 105. Again, this is great for when you're layering our DPA with other programs such as Equity Builder program or a city program, municipality program. So just keep those in mind for the layering purposes to be able to have more qualifying for borrowers, first-time home buyers. As we know, it is a bit of a challenge these days. So all of these programs help. These are the income limits, and I'll just spend a little bit of time. I'll just use Essex County. We're looking at total household income. Anywhere in the Commonwealth for the Workforce Advantage, you can qualify for DPA at $30,000 for eligible borrowers, but the income is based on total household and how many people are occupying the particular property. So if you have a mom with 3 small kids and she was buying in Peabody, we would be looking at a household of 4, and that would be $118,450. And that's just to kind of give you an example of how we look at that sliding scale. Next, we're going to go into our equally popular program, which is the first-time homebuyer program. This product only looks at borrower income, so it does not look at total household income. So in my example of, let's say, a husband and wife and 2 grown children that are gainfully employed, we would only be looking at the husband and wife's income if they're the only one executing the purchase and sales and going on the deed and being on title. So borrower income versus total household income. This is also an equally aggressive interest rate, an attractive interest rate. We have no loan level pricing adjustments on any of our programs. And we have charter level coverage. So that means a reduced coverage. If you're comparing this to Home Ready, a Home Possible, this has reduced mortgage insurance coverage and also offers the MI Plus benefits. For single family properties, we do not have any borrower requirement for own funds. However, for the multifamilies on the conventional side, we do have 3% of the borrower's own funds into the transaction. And down payment is available statewide, $25,000 for the entire Commonwealth. Homebuyer education is important to us, as is landlord education. And again, the overlays for our credit is 640 and 45 across the board. We do still offer the $2,500 closing cost credit for eligible service members and veterans. So this is important, and this is the income limits based on the entire state. And just looking in Essex County again, just to keep it consistent, if someone was purchasing in Lawrence, they could, borrower income could qualify up to $164,200. And then if that same borrower was looking to purchase in Bristol County, in Fall River, it would go to $140,400. However, if they decided to purchase in Taunton, it would then go to $127,700. So these income calculations are already calculated for you. And this is for our first-time home buyer program. It is an equally popular program, as popular as our Workforce Advantage. Again, the layering of DPA is crucial for a lot of these loans and a lot of these first-time home buyers. Some of our other programs that we offer is the below 80% product. This is not total household income. So this is an 80% product for purchase and limited cash out refinances. It does have charter level coverage, so reduced mortgage insurance coverage. We do allow for renovation on this program, as we do for the first time homebuyer program, and there are no loan level price adjustments. Borrowers that are purchasing multifamilies do have to have 3% of their own funds into the transaction. And we do allow for down payment assistance for any first-time homebuyer using this product who is purchasing in a gateway community. And we'll talk about the 29 gateway communities. They're available, including the city of Boston, Framingham, and Randolph. So it is not available statewide for this program, but it is available for first-time homebuyers, eligible first-time homebuyers who are purchasing in gateway communities. I would also just like to point out that this is a product that right now limited cash out refinances are not very popular, but they could be in the future. And this allows for the higher loan to value refinance, limited cash out refinance transactions to be done with MassHousing. And also can be done, we also see purchase transactions as well in this product because we're not looking at the total household income, but just borrower income. And it does allow for the renovation feature and the $2,500 closing cost credit for service members and veterans. And then we have our above 80% product. So this is the highest income product. It goes to 135% of AMI, again, for purchase and limited cash out refinances. And we do not have a first-time homebuyer requirement for these programs, for these two programs that I'm just referring to. But if they are a first-time homebuyer, an eligible first-time homebuyer, and are purchasing in a gateway community, they can be eligible for down payment assistance for $25,000 statewide. The same overlays apply, 640 and a 45 debt to income ratio. If they are purchasing a multifamily, there are no loan level price adjustments, but the borrower must have 3% of their own funds into the transaction. And renovation is allowed, no loan level price adjustments. And you're using Fannie or Freddie to submit all of these loans. So With MassHousing, you have the ability to either submit through Fannie Mae, DODU, or with Freddie Mac and LPA. And there are different pricing options and different guidelines that we adhere to depending on whether or not you're submitting that loan to Fannie or Freddie. So for instance, if you're using Freddie Mac to submit that loan, LPA, and you would be adhering to the Freddie Mac recommendations that come back. If there are reserve requirements, if it is student loan debt, then we would be adhering to those guidelines based on the GSE, okay? So these are the income limits broken down for both the below 80 and the above 80 up to 135. So I'm just going to stay consistent in Essex County. At the 80% of AMI, we're at $113,040 for borrower income, not total household income. This is borrower income. And then going up to the 135, the above 80 product, that is at $190,755. So that is borrower income if they were purchasing in one of the gateway communities. Peabody, Lawrence, Lynn, Haverhill, Salem, Methuen, you can see them bolded. Those communities, borrowers could obtain, eligible first-time home buyers could obtain DPA at $25,000, both on the below 80% product and the up to 135% product. Okay, so I'm going to talk a little bit about our mortgage insurance and what we are. So MassHousing acts not only as an investor, a lender somewhat, and also as a mortgage insurance provider. So we have our own MIF, mortgage insurance fund, and we offer MI Plus, and that has been around for a really long time. I've been here with MassHousing, as I said, for just about 19 years, and MI Plus has been around longer than that. And we're unique. We're one of the few housing agencies that has our own mortgage insurance fund. And we're proud of the fact that with Workforce Advantage, you do get the benefits of mortgage insurance or MI Plus with MassHousing, but there's no cost to the consumer. We cover the cost. With our first-time homebuyer program and our below 80 product, it is a reduced mortgage insurance. And then our above 80 product, or up to the 135%, it's standard mortgage insurance. But this benefit is unique because if a borrower loses their job, we will help cover their mortgage payment. There is no additional cost in the Workforce Advantage product. We cover that. And then we will pay up to $2,000 per month with no repayment. It is good for, it kicks in month 7 of the borrower paying as agreed for the first 6 months. And it is good for 10 years of the loan. And we're proud to say that we've paid a lot of benefits since March of 2020. And we continue to pay out benefits. So it is a great insurance protector, but not only for the lender. If you're a portfolio lender, you can use MI Plus on your own portfolio for loans that you're selling to Fannie, Freddie, or the Federal Home Loan Bank. But if borrower, a single borrower that's buying a home, if they lose their job unexpectedly and they're not self-employed, they receive benefits through the Division of Unemployment. We will automatically help cover their mortgage payment. So it's a great benefit, and it is unique to MassHousing. So next I'm going to go into our FHA loan products and just talk a little bit about our products as they stand today. As of March 18th, we have 2 new products that we've enhanced. 1 new product and 1 product that we've enhanced, I should say. So we have our Workforce Advantage FHA with DPA. It has the same down payment assistance terms. So that would be $30,000 amortized over 30 years at a 0%. It is a no loan level price adjustments. This is total household income that we're looking at, very similar to our conventional product with Workforce Advantage, but it adheres to FHA guidelines. So FHA mortgage insurance and not our MI Plus with the unemployment payment protection. And as of March 18th, borrowers would be responsible for the upfront mortgage insurance premium and their own monthly FHA mortgage insurance. There is no minimum loan to value, and this is available statewide for 1 to 4 unit properties, condos that are FHA condos that meet the FHA guidelines, and PUDs. And again, we do offer the $2,500 closing cost credit that's eligible for service members and veterans. We are adhering to FHA guidelines on borrower contribution on the multifamilies, and again, no loan level price adjustments. So this is a great opportunity for those loans that may not run conventionally. So you have a MassHousing Workforce Advantage on the conventional side. Maybe that loan doesn't run with Fannie or Freddie, but it may run as an FHA and give that first-time home buyer the opportunity to purchase with down payment assistance. The income limits are the same. So that same example that I used earlier, if it was a husband and wife and 2 small children, and they're buying in Lynn, that income would be $118,450 for the Workforce Advantage FHA. And then this is a brand new product that we just introduced last week. This has aggressively priced interest rate. It has expanded income limits, and we look at borrower income limits, not total household income limits. And there are no loan level price adjustments. It's available down payment assistance statewide, $25,000 statewide for eligible first-time homebuyers under this program. And again, FHA insurance applies, as does FHA guidelines. So if the property is near a gas station, that's an issue for FHA. That would be an issue as well. And borrower contribution on a multifamily, we would be adhering to those guidelines. You're going to be submitting this loan in the AUS using FHA and adhering to the guidelines. There is no minimum loan to value. This insurance is insured by FHA, no loan level price adjustments, but there is also a $2,500 closing cost credit for eligible service members and veterans. These are the income limits. Again, they are the same. So if I'm going to stay in Essex County for the FHA first-time homebuyer product with the DPA at $25,000, if they're purchasing in Lynn, the income limit borrower income would be at $164,200. If they're then purchasing in Saugus, it would be $149,300. This is our team. And before I kind of open it up to questions, I just want to kind of share a few things. If you have not been out to MassHousing.com, which is our lender platform or portal, you will see that we have trainings available throughout the month of April. We offer trainings on a weekly basis. Most of the product trainings are done on Wednesdays, and you'll be able to register for those trainings on Monday, April 1st. And we also have underwriting or compliance training that's available. We have loan submission training that's available. So there's a multitude of trainings that are available for you to take advantage of if you're a lender. We also have marketing material that if you go to MassHousing.com, you will see our available co-branded marketing material for you as a participating lender can take advantage of it. And we would just ask that you take advantage of the co-branding. You just submit it in for us to review it and just vet it. But that is something that is an opportunity. We also want to just mention that this is our team, and most of you know Angelo and I. And as you can see, we have Ellie and Jeff who are new to the team, and most of the team members are bilingual. It's important for us to be able to communicate with not only our lender partners, but our consumer partners in their own language. And we do have some things that are coming out in April that I just want to sort of share. We have an Energy Saver home loan program for participating lenders who participate in our second mortgage programs, because we do have an umbrella of second mortgage programs that are available. But Energy Saver home loan will be coming out on April 22nd. And if you are interested in more information, please reach out to me after today's presentation. And I just want to thank everyone for, first for the MMBA, for the opportunity to talk about these programs, because they're important, and for MHP for presenting alongside with me today. We were able to help over 3,700 borrowers last year. It's important, the work we do. And we're hopeful that we are going to have another successful 2024, but we can't do it without our lending partners. And so if you want to find out any more information, please feel free to reach out to us. And at this point, I'm going to stop sharing and see if there are questions that we can help answer.
There are questions.
Excellent. I
All
love when there
right.
are questions.
I do too. So as a reminder, if you do have any questions, just put them in the chat. So the first question has to do with the Fannie Mae HFA preferred down payment is only for specific cities and towns. However, product can be used statewide with no down payment. Is that correct?
No. The down payment, kind of, but no. The down payment assistance at the 25,000. Okay, so the green down payment assistance, if we're looking at, if your borrowers qualify for the first time home buyer product, you can obtain DPA at 25,000 statewide. Okay, those are MRB funded programs, and anyone in that particular product can obtain DPA at 25,000 statewide. Only in the below 80 and the above 80 product, you can still obtain 25,000 if you're an eligible first-time home buyer purchasing in a gateway community. Okay, so blue products, if we're going to, refer to them as colors, the blue products, the below 80, above 80, only in those products where we go to the higher income would be for eligible first-time home buyers who are purchasing in a gateway community. For our first-time home buyer product, the green product, that is statewide eligible for first-time home buyers who qualify. So I hope I answered that question. But if you have any questions after this and you want to get on a call with me, feel free to reach out because I'll be able to talk a little bit more about it.
Okay, so we have a few other questions.
Sure.
So does MassHousing still require a minimum number of mortgages to be sold per year?
So MassHousing has a requirement. We have over 40 lenders who are waiting to get on board as a MassHousing approved lender. We have a minimum participation to participate with MassHousing. That means that you could either use mortgage insurance with MassHousing, participate in our second mortgage programs with MassHousing. But if you're just a first mortgage lender, our requirement is 5 loans.
And that's per calendar year.
It is per calendar year, 5 loans. Yeah.
Okay.
However, if you participate in our second mortgage programs or participate in our mortgage insurance, and actually participate in the MI Plus, then we certainly would waive that or consider waiving the 5 loan minimum. And to be honest with you, we typically do not do anything in the first year with any lenders. We try to keep lenders on because it's important. But there's also something to be said about lenders who are comfortable with our programs and know our programs, because we continue to change them and improve them. And we want to be able to better serve first-time home buyers with partnering with lenders who understand our programs. So good question.
And you're also expanding those that can have access to MassHousing funding. So right now it's depositories and mortgage lenders, and I believe you have a pilot program.
We do. We have a pilot program with specific brokers who were goal oriented, like we are with BIPOC lending. So we do have a pilot program that launched last year, but we continue to have an overwhelming response to lenders wanting to participate with MassHousing, which is a great thing. But we obviously, want to make sure that we have active lenders that are on our lender list, because they are listed on our website, masshousing.com, which is our consumer website. And for anyone that wants to stay connected with MassHousing, you can do so by, obviously signing up for our news and announcements. But also for consumers or first-time home buyers that want to stay connected, they can do so on MassHousing.com and receive notification if we're rolling out new programs or things of that nature.
All right, another question. The
Sure.
2% origination fee to reduce the rate. How
Pros
does
and
this
cons.
how does this compare to daily rates published that includes points to buy down the rate?
So just to clarify, we expanded the DPA, obviously to be used for down payment assistance, but also to be used for closing costs and in the direct reduction of interest rate. So basically, as we're saying that our guidelines up to 2 points can be paid to as long as there's a direct reduction in the interest rate to the consumer. So you would look at our pricing. If you're pricing in Optimal Blue, you can reduce that rate. You could set the loan at par, or you could certainly reach out to us and we can talk to you about how to structure that. But it is allowable as long as it's not a high cost, high price loan. And there needs to be a direct reduction in the interest rate, a benefit to the consumer to reduce the interest rate.
Okay.
It's important because the affordability for first-time home buyers, we all know it's hard. So if we can help them to be able to pay for those points to reduce the interest rate, that can help structure and help some first-time home buyers.
So speaking of first-time home buyers, does MassHousing only lend to first-time home buyers?
No, no, although the bulk of what we do is geared to first-time home buyers. We do have both the below 80 and the above 80% products. So the blue products, I feel like I'm going back to Garanimals, but the blue products, for those of you who remember what Garanimals were, the blue products are not limited to first-time home buyers. However, if for MassHousing, if you want to obtain down payment assistance, you must be a first-time home buyer. But we do offer limited cash out refinances. Not super popular right now, but maybe in the future they will be, especially with the limited cash out refinance at the higher loan to values. And don't forget, the combined loan to value goes to 105 as well.
You touched upon MassHousing offering some other programs. Do you just want to quickly list them? You know, especially we're in an environment that maybe you're purchasing something that needs a little TLC, some fixing upper.
Yes, yes. So we offer the renovation feature to our first-time home buyer program on the conventional side, as well as the below 80 and the above 80% product. We all know that we have an older housing stock in the Commonwealth of Massachusetts. That's a fair statement. And oftentimes, first-time home buyers find a home if they can find a home after struggling to find a home, but it may need some work. It could be Title V. It could be a new roof, new windows. We offer the renovation feature. That is a smaller number of lenders who participate in that, a little less than 40 lenders. But again, that can be found on our website, or you can reach out to us, to me, if you have any questions about who's participating or if you're interested in participating. But the biggest program that we have coming out soon is our Energy Saver Home Loan, part of the Green Bank initiative that Governor Healy announced, and MassHousing was allocated funds. We're happy to say that we're in the final stages of putting together a participating lender list, and also training lenders come April. So if you're interested, there's still time. There's a small window of opportunity, and we can certainly talk about it offline. But this will be for Energy Saver existing homeowners under the umbrella of our second mortgage programs, but all around improving energy. And we can talk more about it as we move forward, but we're hoping to roll that out on April 22nd.
Perfect. And then one last question, and then I'm going to turn it over to Elliot. How can borrowers and or lenders stay connected to MassHousing?
Great question. Okay, so if you're a borrower, you can go to masshousing.com and you can stay connected with us. We don't cross-sell, we don't solicit, but you will know when we have new down payment assistance, if we do change down payment assistance in the future, if we're rolling out a energy saver home loan product, and you can just stay connected with us. If you're a lender, you obviously, if you're a participating lender, you know to go to emasshousing.com and you can find all of the resources available. We have all of our guidelines, all regs, our guidelines are available to you. Our doc sets are available to you, our product matrices, our lender trainings, which are very important, as well as marketing flyers. And you can reach out to our team. You can reach out to me if you have any questions, and I'll share my direct contact. You have my email, but I'll give you my cell phone number if you need to reach out to me. At anyone that's on this call and has any questions after today, I'd be glad to talk to you. If you're a lender who is not approved with MassHousing, we do have a long list of lenders that are pending, but certainly reach out as well, and we can get you on that list.
Perfect. Well, thank you so much. And
Thank
I know
you.
you're sticking around to the very end in case we have questions for you again. So, on that note, I am going to, there he is. I'm bringing up Elliot.
I'm going to share my screen now, Debbie.
Yes.
All right, hopefully everybody can.
That is perfect.
Okay. Hi again, everybody. Again, I'm Elliot Schmiedel. I'm the Director of Homeownership at MHP, and glad to be here to talk about our homeownership programs. So I'll take you through the agenda just real quick here. Besides telling you who I am, I'm going to talk about who we are, what we do. How does MHP perhaps differ from MassHousing? How do we, work similarly? What are the ways in which we work towards creating more affordable housing throughout the state of Massachusetts? I will go through a little bit of an overview of our product offerings. Won't get too in depth, but happy to take questions that delve a little deeper. Talk about a recap of 2023. Want to touch on some numbers attributed to the One Mortgage, the Mass Dreams program, our One Plus Boston program. And then we'll look ahead, talk about some of the things we are thinking about, working towards before we go into questions. So with that, a little bit about MHP. We've been around since 1985. We are a quasi-public state agency. Our goal, our mission is to increase the supply of affordable housing throughout the state of Massachusetts. We work really closely with state government, with local governments. We want to pioneer new development. I think that we're all very aware of the housing supply shortage that we face here in Massachusetts. It is only getting worse. So we want to be innovative, come up with new financing models, make more effective use of public funds, and be, really responsive to the needs of local communities. Massachusetts, with 351 local cities and towns, is very diverse, very complex, and we want to make sure that local needs are being met. We want to promote racial equity. It's again, obviously, something that's near and dear to our hearts. I'm going to talk a little bit more about that as it relates to One Mortgage. But Massachusetts is still a place where the homeownership gap is very wide. The wealth gap is very wide. We want to create housing opportunities for all, and a lot of that centers around promoting racial equity. And then we want to think outside the box, work in ways that are outside the box and maybe not seen as conventional approaches. So I think we pride ourselves on always having been a pioneer and a leader on innovative approaches and strategies. Just real quick, couple, MHP is not all about home ownership. We have a community assistance team. The community assistance team works really hard to support communities, public housing authorities, nonprofit organizations who are looking to develop both rental and ownership housing. They draft RFPs, they consult on local zoning issues, help with pre-development, and then do a lot of education and planning assistance. I'll put in a plug for our Housing Institute in June. It's a great place where local housing professionals and planners can go and learn A to Z what it takes to promote, advocate for, develop, and finance affordable housing throughout the state. That would lead us to our rental financing team, probably the largest team within MHP. They financed over 28,000 units in our organization's history, 75% of which have been made to low and moderate income households. Most of that capital comes from Interstate Banking Law, Chapter 102. That allows us to borrow long-term capital at a fixed rate basis to finance affordable housing. The newest team at MHP is the Center for Housing Data, or CHD. CHD works really closely, again, with state government, local governments, research firms, think tanks, collect, interpret, share data. They want to inform community conversations, right? Data is important, data is meaningful, and they are taking different approaches to distill and share that data. They've come up with a couple really unique tools, some of which they just won a few awards on. Those include DataTown, Todex, and Residencity. I knew I'd get that one wrong. They write policy briefs, conduct research, and have been an incredibly impactful team in their short tenure at MHP. And then there's the homeownership team, and that's the team that I run, and that offers our One Mortgage or One Plus Boston. We work with banks and credit unions across the state, from small local community banks and credit unions to mid-size to larger regional banks. And our goals are your goals, really. We want to help you meet your CRA needs, meet your community lending needs, and above all else, create more opportunities for LMI first-time home buyers. So I'll just talk briefly about, just here's an intro to One Mortgage. That's the pillar of what we offer. It's a state-sponsored below-market mortgage product. It's designed specifically for first-time home buyers. So I think that's one distinction between MHP and MassHousing. Our homeownership offerings are exclusively for first-time home buyers. If we go way back, there was a program before One Mortgage called the Soft Second Loan Program. That was created in 1991, over 30 years ago. It was created in response to racial discrimination in mortgage lending in the greater Boston area. Banks, state and local officials, community partners came together and said, we need to come up with a solution to help reach underserved households, help reach households of color, and help them buy their first home. And from that came the Soft Second Loan Program in 1991. And since that time, Soft Second and One have combined to lend to over 25,000 households. And those are 25,000 households who, in many cases, if not for this product, would not have been able to buy at that time. So really, really proud of that legacy and that history, and hope to carry it forward for years to come. I'll talk a little bit about what makes the One Mortgage model unique, because it is a little bit different. And first off, I'll state, overarchingly, this is a portfolio product. This is a product that our lender partners are originating, closing, servicing, and retaining ownership of. In very limited cases, there are transactions that happen, and we can help facilitate those transactions, and happy to. But I think that, again, we have very similar goals to our lenders, and a lot of these loans, our lenders prefer to keep on the books. It's a customer relationship, and it's something that they're in many cases happy to retain ownership of and service. The low down payment's the first feature. It's 3% down payment for condos, singles, and two families. 1.5% of that does need to be the borrower's own funds. And then, of course, the 1.5% remainder can be met with a gift or a grant. Increasingly, we're seeing the amount of down payment assistance programs being used, either state programs like Mass Dreams, or local programs offered through the community or a local nonprofit. For three-family properties, it's a 5% down payment, little more skin in the game required there, 3% of which needs to be included or needs to be the borrower's own funds. The most unique feature possibly of One Mortgage is that there's no private mortgage insurance, no PMI ever. And so you might be asking yourself, how do we make a 97% loan, or ask you, the lender, to make a 97% loan with no PMI? Well, we have a loan loss reserve. Which is publicly funded, which MHP administers, that is going to help mitigate the credit risk associated with these loans. And that loan loss reserve has gone a long way to helping lenders produce more One Mortgage loans. The interest rates are low, and they are fixed for 30 years. we require lenders to offer one mortgage at a discounted interest rate, and that discount amounts to 30 basis points below the weekly Freddie Mac rate. So every Thursday at noon, we're going on to Freddie Mac's primary mortgage market survey, taking a look at their rate, and then plugging into our system a 30 basis point discount, and that's our cap. And that is something that our lenders are offering as part of the program, and makes a huge impact on the buyer's ability to qualify, help stretch their dollar a little bit further. And then the last unique feature here is state subsidy. So there are public funds wrapped into these loans, and they are wrapped in two ways. The first is that LLR that I talked about, and the second way is through state subsidy. So buyers under 80% who have a housing ratio over 28 are going to qualify for subsidy. And what we're going to do is try to apply as much subsidy as we can, up to our $15,000 maximum, to bring their housing ratio, their front ratio, down as close to 28% as we can. We want to get people in homes, but we want to also sustain them. So it's important that they have an affordable monthly payment. And interest subsidy is secured with a second lien from MHP. It is a 0% interest deferred repayment loan. We do subordinate those loans, and we do also have forgiveness provisions built into the note of that loan that allows for us to forgive subsidy in the case that somebody is selling with very little appreciation or no appreciation. The market's been very strong, over the past decade, but that hasn't always been the case. And sometimes there's instances in which we don't want to be the ones compounding the borrower's, financial difficulty due to current market conditions. So those are ways in which, the program is unique and more affordable than conventional mortgage. I'll talk real quickly about borrower eligibility. As I mentioned here at the top, first-time home buyer program only. We require our lenders to collect 3 years of tax returns, and in those tax returns, make sure there's no evidence of mortgage interest deduction, real estate property tax deductions, and things like that. And that does go for all adults in the household. That's not just the mortgager. That's their spouse, fiance, domestic partner. Any adult over the age of 18 needs to qualify as a first-time home buyer, because we are truly trying to funnel this program to those who need it most. Homebuyer education is also a pillar of our program. Every single borrower needs to go through a pre-purchase homebuyer education course. We have a wonderful agency called the Citizens Housing and Planning Association, CHAPA. Through their Mass Homeownership Collaborative, they certify courses throughout the state. There are many dozen partners across the state in all regions who offer homebuyer education classes, and at least one borrower on every one of our loans needs to take that course. Household income is a huge pillar of the program as well. As I mentioned, this is a program focused on low and moderate income households. For that purpose, we use 100% area median income for dependent on household size. Our income limits are too many pages to just share in a deck. They're about 6 pages long, I think, but we split the state up into they're called metropolitan statistical areas, MSAs. They roughly go by county lines. And you can quickly reference those income limits on our website to find out, if your client sitting across from you is a household of 4 buying in Springfield, you can easily reference what the income limit associated with that household would be. It is total household income, so that is a distinction as well. We are not asking our lenders to just evaluate borrower income. We are asking our lenders to evaluate income from all adult household members over the age of 18. And when our lender partners, we have a team of program coordinators who work really closely with our lenders. And, the number 1, 2, and 3 questions we get revolve around compliance income. I think it's a very common set of questions around, do I count this? Do I count that? And, for those partners who work with us, they know, bring your questions. We're happy to answer them. The asset test is also something that helps us target, underserved populations, those in need. We have a $75,000 asset limit. Assets include, liquid checking, savings, stocks, bonds, capital investments, real property that folks might own. What it does not include are retirement funds. So your 401ks, 403bs, IRA accounts are not counted as liquid and therefore would not disqualify somebody from qualifying for our program. So that's an overview of eligibility to help you get a sense of what borrowers and who might qualify for our program should they be, contacting you and looking at their product options. Our underwriting ratios are as stated here for singles. So first off, we finance 4 property types: condominiums, single families, 2 families, and 3 families. And condos and singles are lumped together. We have 2 tiers. We have tier 1, 33 on the front and 38 on the back. And if you run a tier 1 loan through our system, as long as it's got a credit score above 640, it's going to receive an automatic approval. If you run a condo or single through our system and it comes out at tier 2, meaning up to 3643, we're going to require at least 3 compensating factors. And that's where we'll reach out to our lender partners and ask questions about employment stability, reserves, debt breakdown, and things like that. 2-family properties have a 1-month reserve requirement right off the top. We do count 75% of rental income to help them qualify. Rental income does not count against them for compliance income limits, though. It'll help them with qualifying, but it won't hurt them with the income limits. And our ratios on 2 families are 45-50. 3-family properties, we require 5% down, as I mentioned earlier, a 2-month reserve requirement. And we just look at one ratio, 50% debt to income ratio. And again, the 75% of both rental units is going to be factored into that ratio to help them qualify. So, over the history of our program, 2- and 3-family property has been a wonderful way for folks to get into home ownership. They're becoming very expensive in the greater Boston area now. I think we still work with a lot of partners statewide who offer multifamily landlord counseling. It's a daunting proposition for somebody to purchase their first home and become a landlord for the first time, all in the same fell swoop. But as long as they're prepared and financially ready, it can be a wonderful, wonderful investment and opportunity for them. So I did mention earlier that more and more folks are taking advantage of down payment assistance from various sources, and our program works really well with a number of programs. So you can certainly pair one mortgage with municipal down payment assistance that might come in the form of home funds or CDBG or CPA funds. Federal Home Loan Bank's Equity Builder and HOW programs very commonly pair with one mortgage. There's more and more matched savings plans, different individual development accounts. There's the Stash program offered by MAHA that they hope to take to a broader geography very soon. The Family Self-Sufficiency Program, FSS. If you're working with borrowers who have a Section 8 voucher and are interested in using that Section 8 voucher to apply towards homeownership, we work with lenders who underwrite and close Section 8 to homeownership loans with one mortgage. One of our lenders recently closed a first loan on a Habitat for Humanity property, which is really exciting. And there's different variety of programs that might work as well. The assistance from these programs does not count towards the asset test, and matched savings funds do actually count towards the borrower's own 1.5%. So we really want to try to be flexible in the way that we are leveraging, and we're allowing our borrowers to leverage these programs, because we know that without them, a lot of folks under 100% AMI might be shut out of the market these days. So I will talk a little bit about 2023, a year in review, as it relates to our various programs. I'll start off the top with one mortgage. This is sort of the foundation for everything else. We did 622 loans in 2023. I will acknowledge that was a down year, but it's probably not news to anybody that it's been a down year in a lot of ways. Those 622 loans were spread across the state and originated by about 40 different lenders. So we work with about 45, and I think about 40 originated a loan in 2023. 51% of those loans went to households under 80% AMI. And again, just to reiterate, 100% of those loans went to households under 100% AMI. The race and ethnicity breakdown was 70% of those loans went to BIPOC borrowers. That's the highest percentage in the history of our program. I think in large part thanks to Mass Dreams, which I'll talk about in a minute. But you know, we work really, really hard to reach BIPOC borrowers through our outreach, our marketing, our advertisements, our nonprofit and community organizations. And it's been a legacy of our program for many years. And in recent years, we've, I think, doubled down on those efforts and been pleased to see some results. We did 244 loans in gateway cities. And again, those are, you know, if folks don't know exactly what the gateway cities are, they're places like Springfield, Worcester, Lowell, Lynn. There's 26 of them spread across the state, and 210 loans in Boston. And little anecdote, when this program first started back in the early 90s, it was only offered in Boston, and we did hundreds of loans in Boston. But then we spread out statewide, and the number of loans in Boston dwindled and dwindled. But since the introduction of our One Plus Boston program, which I'll get to, we've noticed a great resurgence of our ability to reach buyers in Boston with some unique program offerings. Mass Dreams, as has been mentioned before, unfortunately, is no longer operating. It was a great program while it lasted, and we're certainly hopeful that it's going to be, you know, be recontinued. In 2023, we awarded $13.7 million in Mass Dreams awards to 520 households. 63% of those households were below 80% AMI, and 78% were BIPOC, self-identified BIPOC households. Our community breakdown was very similar to the overall volume. 230 Mass Dreams awards were made in the gateway cities, and 200 in Boston. And there were a few other cities and towns actually that don't quite qualify as gateways, but were included in Mass Dreams as well. Framingham, Randolph. And Mass Dreams, of course, was based on eligibility, was based on the current community which you rent, not necessarily the one you buy. So that's, I was even double taking the numbers, but folks could purchase in a non-gateway city or Boston if they wanted to. And here I'll pivot to One Plus Boston. This is a program we introduced with our partners at the Mayor's Office of Housing in 2020. To date, we've done over 500 loans, but in 2023, we did 196, which is a great year. 67% of those loans went to households under 80% AMI, and 67.7% went to BIPOC households. And I'm going to sort of delve a little deeper into this product for a few minutes here and talk about what makes it different and what's made it so impactful. But I'll start with the need. You know, the need, as I stated earlier, became glaring as we moved in towards 2019, 2020. It was harder and harder to reach LMI buyers in Boston. One-bedroom condos are $500,000. You know, multifamily properties, which had long been a bread and butter in places like Dorchester and Mattapan, Hyde Park, were $8-9 million. And the math just was not adding up. There was a gap there, and traditional financing was not helping to close that gap. So we strategized long and hard with our colleagues over at the city, participating lenders, nonprofit community organizations. And the result was a program called One Plus Boston that is, you know, founded around one mortgage, but it includes a unique rate reduction. So currently the program is being offered with two tiers. The first tier is a 100 basis point rate reduction. We are using city CPA and ARPA funds to compensate lenders for the rate reduction, but that is a permanent rate reduction, which is going to lower the borrower's 30-year note rate. So that first level is 100 basis point reduction, and the second level for borrowers under 80% AMI is a 200 basis point reduction. And this is no small feat. You know, this took a lot of brain power and participation from our lenders to put together. We started with 4 lenders. I think we're up to a dozen now. And the results have just been, I think they've exceeded all expectations. The city at the same time is producing, with help from even MassHousing's Commonwealth Builder Program, producing a lot of ownership units throughout the city, a lot more than they have. And our product pairs really well with folks qualifying for those affordable units. Now, just talk about the power of the rate reduction a little bit. I don't even have to explain how increasingly difficult it's become to buy a home in Greater Boston. But the benefit of the interest rate reduction, really helps stretch their dollar. There's a statistic I read a while back that said for every 1 point change in interest rates, as interest rates go up, as they go up by every 1 point, it knocks about $40,000 in purchasing power off somebody's ability to qualify for a mortgage. So in the past several years, we've had rates more than double, and we've had prices increase by 30–40%. So it's a real negative correlation. It's literally just compounded first-time homebuyers' ability to get into the market. Research by the Urban Institute found that interest rate buydowns are going to allow for greater affordability. Again, they're going to stretch that dollar, allow somebody to qualify for more. And the result will be higher rates of equity building. We want to get folks into homes, but we want to help them sustain home ownership over the long run as well. We've been really proud of the fact that over our program's 30-year history, despite making loans to what wouldn't be considered prime borrowers, our loans perform like prime borrowers. That's in large part due to the affordable nature of the product itself, but also the delinquency counseling. As part of our Home Safe program, we are making referrals to contracted counseling providers who are following up with borrowers every month if they're reported as 30 days, 60 days, 90 days delinquent or in default. And we're really trying to work with those borrowers. Our counselors are trying to work with those borrowers to assess their situations, help them get back on track. And that process runs in tandem to the lender's loss mitigation strategies. And it's been something that's helped the program immensely over the years. So we'll look ahead for a minute before I take questions. Just a few things that we are thinking about and working on. We're looking to make some updates to our program guidelines. Pretty soon, we're going to announce some changes, updates that will revolve around things like our asset limit, our ratios, and other things that pertain to borrower eligibility and underwriting, all in the name of creating more opportunity. We really realize how expensive it's becoming. The margins are smaller for home buyers, and they really have to thread a needle. And we want to try to make that a little easier within reason. And so stay tuned. We hope to announce some changes very shortly. As mentioned before, we are very hopeful that Mass Dreams, which does have a proposed $50 million line item in the Affordable Homes Act, otherwise known as the Housing Bond Bill, passes. We'd love it if it's more, Debbie, just like you, that'd be great. We at MassHousing used those funds, I think, very effectively over 2023 and 2024. And that program's continued funding is really critical to first-time homebuyers across the state. I talked about One Plus Boston, and it is, I realize, a very local program funded by the city of Boston in large part, but we think that we've got a model that's been very successful, and we are in conversations with other localities around the state. We'd love to take the One Plus Boston model and scale it up. We might start with a few towns, but we'd love to bring it to a broader set of cities and towns across the state. It's possible that the program terms could vary from place to place, but the overall idea is very similar, and it would be centered around a permanent 30-year rate reduction, in part funded by state and local funds. So stay tuned, but those are the things that we are thinking about and trying to move forward on. And with that, contact information here. Suzanne, who was not able to present today, is available at scameron@mhp.net, and happy to talk with any lenders who are interested in learning more about the program, learning how you can partner with us. It's a very simple process, and we'd be happy to have those conversations. But Debbie, I'll see if folks have questions.
Yeah. Do you want to maybe stop sharing? Oh, perfect.
Sure.
Wonderful. So, I know that we have one that I'm actually saving to the end,
Okay.
because I want to ask both of you a few questions. But for you in particular, what do lenders need to do in order to offer the one or the one plus Boston?
Yeah.
How do they get involved if they're not already?
One mortgage, first and foremost, contact us. And we would love to, just engage further, answer your questions, talk about the program, see if it might be a fit. We have one program, one document, sort of contractual agreement, which we call the program agreement, which would govern the relationship between MHP and the participating lender partner. We have a system that we call ES2, which is a loan boarding system. Very easy to use. We would provide in-depth product training and system training. And once the conversations have been had and the trainings have taken place, lender is free to start originating loans. We don't have a minimum loan requirement. We have lenders that do just a handful of loans every year, and some that do dozens and some that do hundreds. But it's a pretty easy process, and we are happy to work with you. Once you become a lender, we would assign a program coordinator to your account, and that's your person who you reach out to, on a daily basis if need be, with questions and product scenarios and things like that. You can find more
So,
information on our website too, about the program, but we're happy to share it in a face-to-face meeting or a Zoom meeting, whatever that might be.
so you don't have like a backup, there's not like a waiting list if people want to join.
No,
It's
nope.
pretty perfect. Okay. You started mentioning as far as no PMI and this loan reserve.
Yeah.
Do you want to give us any additional information about how does that work? Everyone's talking about risk assessments and making sure you've got enough capital and Basel III and all of that. So to have loans that don't need PMI
Yeah.
is kind of fascinating. How
Yeah,
does it
it's
work?
different. It's different. It's unique. So the loan loss reserve is publicly funded. We receive funds every year through the Affordable Housing Trust Fund. And here's how it works. So in lieu of PMI, MHP is going to set aside a loan loss reserve attributed to every loan that a lender closes. So if you become a partner lender with MHP and off the bat, you close 5 one mortgage loans. We call it the first 5 at 5. We're gonna fund your loan loss reserve with an amount equal to 5% of each one of those loan amounts. So you're building up your pool. And then loans 6, 7, 8, 9, 10, and so on, we're gonna allocate an amount equal to 1% of the loan amount. So it's a pooled reserve unique to your lender that grows and grows with every loan you do. Now, in the event down the road that one of these loans goes bad, and results in a short sale, a foreclosure, a bankruptcy, and as a result of that event, there's a loss that the lender takes. You can file a claim on the reserve with MHP, and MHP will pay up to 80% of a qualifying loss claim. It's a shared risk program. It's really a way in which public funds are combined with private funds from the lender to help mitigate the risk on these loans.
Very interesting. And you might have already mentioned this, but just to kind of reemphasize, the one program is available across the state and not just in
Correct.
particular gateway cities or.
Yeah, great question. That's you can use the one mortgage program to originate a loan in any of Massachusetts' 351 cities and towns. And I actually think pulled a stat on this recently. Over the history of the program, we've closed a loan in something like 310 of the 351 cities and towns. So little known fact, but you can use it anywhere.
Excellent. And we talked about borrowers' ability to qualify for more. And do you want to go into any more detail about how the structured rate reductions of one and one plus Boston help borrowers qualify for more?
Yeah. I guess when you look at it on its on its face, it's the simple math, right? We want to stretch folks' dollar so that they can qualify for more. The average purchase price in our program has gone from, 250 to 300 to 350 to 4. It might exceed 400 at this point. And incomes haven't changed all that much, not
Mhm.
certainly relatively speaking, not that much. And so a gap opened, and we needed to close that gap. And we thought the most advantageous way to get there would be to lower the interest rate permanently. We've had 30 years of history to show how our interest subsidy would work. Interest subsidy effectively lowers a rate, but not technically. And so we wanted to sort of emphasize that point by offering 30-year rate reductions. And that's really helped, because people are qualifying based on that lower rate, based on that lower payment. And that's going to help them access the market. If with a 6% rate, they're able to qualify for 400, well, with a 4.5 or a 5% rate, they might be able to qualify for 450 or 500. And that's at this point, making the difference for a lot of households who are on the margins, on the cusp, if you will.
I bet. I bet. And then probably the last specific question for you is homebuyer education
Yeah.
is crucial in both of your both Mass Housing as well as MHP. But you specifically only work through CHAPA?
We do.
Um,
We take CHAPA approved homebuyer organizations. There's close to 50.
yep.
Many of these organizations do work with the online education provider framework. And so borrowers can certainly take online classes through one of these providers. Um, of course, at this point too, fewer and fewer, if not very few, folks are going somewhere physically to sit down and take a class, right? They're doing most of this through Zoom. Classes are so much more accessible. And I think the number of attendees and homebuyer classes builds year over year. And they're so important for a first-time homebuyer. I always sort of reiterate this, but it's great if somebody can take a class, find out they're ready, and buy in 3 months. But it's also great if they can take a class, find out they're not ready, and plan over the next, maybe 12 or 24 months of when they're going to buy. And I think a lot of that does take place. The home buyer classes are a big feeder of folks for our program. Obviously, we have great partnerships and relationships across the state, and very proud of the work they do to communicate the affordable options that exist here in Massachusetts.
And I'm really, impressed with the CHAPA website that you can sort by location, you can sort by language. So it's really easy for consumers to kind of pinpoint this is the education for me. I know one person has mentioned that the one mortgage has pre-closing and post-closing counseling.
Yeah, well, pre-purchase would be the education component that I
Yep.
mentioned, and the post-purchase counseling is for borrowers who are delinquent. We do make automatic referrals to counselors, and we do a post-purchase class. A lot of our contracted providers offer a post-purchase class, and the difference between pre and post-purchase is, it's literally pre-purchase class is helping you get your finances together to
Hmm.
buy the home. And the post-purchase class is going to be really focused on maintaining and sustaining that home. They're going to talk about home equity. They're going to talk about home equity financing options, hiring contractors, making repairs, and things like that. So folks, borrowers of ours have 1 year to complete a class. Lenders don't have to do anything to make sure they complete that class. We're working with our education providers behind the scenes to make sure that borrowers are reached out to, contacted, and offered those classes.
Perfect. So I'm looking at the chat and I don't see any. If it's okay with everyone, I am going to ask Reddy to join you.
All right.
There we go. Didn't forget about you. So, I have some questions for you. And it was on my list to ask you, and luckily someone else asked you the same thing. So we now have very large standard mortgage deductions. So people aren't necessarily itemizing their mortgage interest and taxes on their tax returns. They're just taking the standard deduction. So how do you figure out now, looking at someone's tax returns that hasn't itemized, if they're a first-time home buyer or not for those 3 years? What do you do?
I'll try to answer the question. We don't necessarily collect the tax returns to determine first-time home buyer eligibility necessarily. We're looking off the 1003, although we require the transcripts to determine that, right? The file transcripts. And we're looking at it for a multitude of different reasons. But we're looking at the 1003, the disclosures that they execute that indicates that they are a first-time home buyer. And for us, it's they haven't owned and occupied a primary residence in the last 3 years.
It's a great question, and I have not been asked that question before, I'll be honest. But now it's caused me to think, and in thinking, I have the same answer as Goretti. We also, in addition to reviewing tax returns, have a disclosure statement, which is going to ask the borrower to attest to the exact same things. And that's going to accompany every application for a one mortgage loan or one plus Boston loan. So there's a bit of a backstop there. But I'm also going to maybe do a little bit of research on that question because it's a good one.
Yeah, and I assume that, if they had been a homeowner, they would have had a mortgage. So you would have had a trace of that mortgage on their credit report,
That's another great point.
maybe, but
Yeah, in some cases. And they're also signing their application with their declarations that says, have you had any ownership in the last 3 years? I think that's one of the last declarations that they actually check off. That's part of what they're adhering to when they sign an application.
so then the question for you both to comment and or think about is, I think initially we got those 3 years of tax returns to verify no home ownership, no real estate taxes, no, whatever. So knowing that that's not always going to be reflected on 3 years of tax returns, why do you require 3 years of tax returns? What's the purpose behind it?
For us, the other reason would be income determination. It's going to help us look at and establish trends in income. It's one thing to collect recent pay stubs, but there are instances where somebody could be earning more or less right now than they have in the previous 3 years. We want to get a sense of those trends. The other big reason is self-employed borrowers, right? Self-employed borrowers are not going to be able to provide pay stubs or W-2s. And so tax returns are the way to tax returns and profit and loss statements to assess their income for eligibility and underwriting, frankly.
Fair enough. Okay. I'm going to switch topics now. And I am also going to put in a little bit of a plug for the remaining series of our Affordable Lending Summit, where April 23rd, it's totally focused upon down payment assistance and from the origination standpoint, putting together and layering those grants and down payment programs that you both referred to. And then we're actually, after that, we're going to do an operational, same topic, but operational. How do you manage on the back office, the processing, the underwriting, those multiple down payment assistant option on one loan? But I'm going to ask you both. We do have federal, state, local, all different avenues for finding down payment assistance. Is there one central spot that consumers, that lenders can go that says, okay, I am looking in this area. Here is what is available to me. Is there a central spot or two that people can go to?
I'll take the or two. I don't think there's a central spot. I can give a plug for our website or the My Mass Home website, which does list a lot of the municipally funded down payment assistance programs across the state. folks will still have to contact those entities and make sure, follow up on that. But to your point, the number of program offerings is growing and growing. It's federal, it's state, it's local. And so I think that's yet to be solved with one central resource. Grady, unless you know something I don't.
No, I think there are a lot of groups that are looking for local answers on that topic. So for instance, there's the Brockton Housing Partnership, the Fall River New Bedford Housing Partnership, where they're trying to determine what availability is in that particular area of the state for down payment assistance. We've tried capturing, especially within 2023, loans that were structured with other down payment assistance or grant. Obviously, we all know of the most popular ones, Equity Builder, but City of Worcester, City of Boston, all the municipalities throughout the Commonwealth have funds. Some of those programs are changing in 2024. So what we tried to put together in 2023, we're still working on it because it's changing. With new programs coming out and various cities rolling out changes or enhancements or improvements, or even brand new programs in the spring of 2024, I think you'll see more. I think, that April 23rd session sounds great from a loan officer perspective on how to originate those loans. And I love the fact that you're also working with the operational staff to make sure that I always say loan officers drive the bus, but someone has to put gas and and make sure the bus is running. So this sounds like a great session that you're having.
Well, thank you. And I know that yesterday's session about Fannie and Freddie, I think Fannie mentioned that they have something on their website that also lists a lot of the down payment assistance programs. So I do think it's an area that there's a lot of digging. The money is out there, and it's just a case of trying to figure out. Unfortunately, I don't think that there is one central location. I just think that there's a lot of digging. But April 23rd, I'm going to find out more about that.
And I think that presents a great opportunity for this is work, but it prevents a great opportunity for loan officers to become that resource too. Of course, there's the home buyer educators, but the more knowledgeable of these programs you are, the more resourceful you can be. I think the better it will help in your ability to serve first-time home buyers.
Absolutely. And, Elliot, I was so pleased that you mentioned that Habitat for Humanity program, because that's an example of educating, because we know that Fannie and Freddie will take sweat equity when you are dealing with for down payment, when you are working with a nonprofit. And, I just think that might be an untapped resource out there for a loan originator, for anyone that's active working with their nonprofits, to maybe look outside the box to figure out how can we get these people into the homes, because it's such a challenging market.
And just ask the questions, right? Yeah, because it's like we might not have all the answers, but we'll try to help you get there.
Yeah, yeah. So and then I'm going to just ask one question that I don't know if it's even fair to ask you both this or not, but here goes. There's been a lot of headlines in the past few weeks about buyers agents and paying buyers agents and commissions and all of that on that sense. The down payment assistance, do you think that borrowers, first-time home buyers, can ever tap into that if they needed to pay for real estate agents to represent them? Or don't we know enough about it at this point?
I think it's probably too soon
Yeah.
to say. Currently, that answer is no from our DPA, right? And
Yep.
I think that's how Fannie and Freddie have
Yes.
approached it
Yes.
as well.
Yes.
So again, I think it's too soon to tell.
Yeah. Yeah.
Yeah, agreed. My mind has gone there and thinking, just like yours probably has, Debbie, how are we to ask LMI, first time home buyers, to come up with
Right.
5, 10, 50, that it's at this stage when we're trying to help meet the needs in the
Hmm.
opposite way. So I think, yeah, we're going to need to really put our heads together and see how this shakes out initially, but be prepared to uh,
Yeah.
come up with something innovative.
Yep. Yep. Absolutely. So, and then I think the final, and it's a comment and not a question. Someone commented in the fact that one mortgage does not require LP or DU findings. I think that that was a comment and not a question.
It's a true comment. So it's yeah.
Yeah.
One mortgage is traditionally understood as a manually underwritten product. You're not required to run it through DU or LP.
Okay, perfect. So as we are wrapping up, I see no more questions. And I just, again, wanted to thank you both for being here. We will be providing your resource material, your presentations to everyone that registered. Um, so we'll send it to the company and then they can disperse it along with a link to this recording. So, do you have, before we sign off, any last words of advice or thoughts, or are we done?
I would just say, and this is really just thank you for putting this together and for making our programs something that, you know, historically people are sort of like, oh, it's more complicated or it has that perception. And that's not necessarily the case. And I think that this is a great time to get familiar with our programs, our products, and for first time homebuyers ultimately who, we all are hoping to help in this process. So thank you for putting this together and for having Mass Housing and myself speak. And thank you to Elliot and for all the work you do across the state. And we look forward to more of these sessions in the future. And if anyone has questions, please don't hesitate to reach out.
Perfect. Elliot, any last words?
I echo those sentiments. Thank you, Debbie.
Okay.
Thank you, Goretti, for sharing the Zoom. And thank you to our lenders too. I think that
Yeah.
we get to administer this program across the state and see all the successes everywhere, but we don't do any of this without lender partners. These are still first mortgage loans originated by the bank or the credit union, and without all the work that originators and closers and processors and underwriters and CRA officers do, none of it would be possible. So it's really a great partnership.
Absolutely. So thank you for lenders. Thank you to the both of us. And stay tuned for April 23rd. Have a
Excellent.
great day, everyone.
Thank you, everyone.
Thanks.